Good evening, colleagues. Thank you so much for joining me. My name is Shiliboy Mutiba. For those who might not be familiar with me, I'm the head of tax at TaxAid with ZA. I'm also head of business development at Mutiba Private Wealth. For those who might not be familiar with Mutiba Private Wealth, what is all about, Mutiba Private Wealth is our financial planning sister company. Yes. All things to do with financial planning are done at Mutiba Private Wealth, and TaxAid is everything that has to do with tax and accounting and advisory. So if you're one of those people that might be looking for help when it comes to your tax affairs, accounting affairs, any business transaction advisory, you're more than welcome to reach out to TaxAid team that has the tax practitioners that can assist you with your affairs. And if you're one of those who are concerned with their estate planning, retirement planning, investment planning, and for that matter, and risk planning, you're more than welcome to reach out to Mutiba Private Wealth, which can assist you with their private clients, advisors that are there. They can be able to assist you when it comes to your financial planning needs. Yes, so if you need that, you're more than welcome to do that. We've got our members here. I saw Zui. Zui is one of our private clients, advisors that is with us tonight. So if you need anything from risk planning, investment planning, and retirement planning, estate planning, you're more than welcome to reach out to her on the comment site chat box, and then she can attend to you. But for that matter, let's get on with the business for tonight. We obviously just heads up, those who might not have been here when I started, I said these sessions are going to be coming through every first Monday of the month. Every first Monday of the month, we'll be having these sessions. So you're more than welcome to actually be on a lookout for them. And yes, we'll be bringing on sessions that has to do with risk planning, estate planning, retirement planning, and tax for that matter, particularly that most of you guys don't want to be good citizens. You don't want to donate to SARS and to the National Fiscus. So then we'll find a way of being a friend and minimizing tax so that you pay as minimum tax as possible legally. So yes, we're going to do. So, but tonight we felt that let's rather start with pretty much what most people always ask themselves. How best can I structure my affairs? Because the truth of the matter is that when you come to financial planning, you come to us and we evaluate your positions, your assets, we evaluate all the assets, whether being policies, whether being investments that you could be making, for that matter, including those properties that you guys are buying. There's always a point of contention to say, where do I house all these policies? Some people will say, listen, Shiliboy, you guys as private clients, advisors at Mutiba Private Wealth, you're telling me that I should be considering to take life covers so that upon my death, all my properties can be settled. Now, in case of the excess, where should this excess be paid out into? Those are the discussions that most people ask, because of course there are tax implications. Of course, there are executors' fees that one will always try to minimize as much as possible. So the contention of investment structures and related tax implications always come. Everyone always asks that type of question. So let's start with that. And then as we go along over the year, during the year, we'll touch on various segments of that has to do with tax and financial planning. If you allow me, my name is Shiliboy. Tonight, we're going to be talking about understanding of investment structures and tax. Then we can go on. As I mentioned, this is our ecosystem for those who might not be familiar with us. We've got Mutiba Private Wealth that deals with financial planning, as I explained. And then we've got TaxAid that deals purely with tax. If you need tax issues, then you're more than welcome to actually reach out to the tax practitioners within TaxAid. And then the private clients, advisors within Mutiba Private Wealth will deal with you on your financial planning. Now, we also have two ecosystem web, sort of a mastermind platforms where people, like-minded people come together. These are SMEs Connect South Africa. If you are running a business and you want to belong to people that are like you, are entrepreneurs, and you guys share ideas and you share the struggles, you share supply chain opportunities, and you meet on a monthly basis and exchange ideas on how do we build these businesses. Some sort of a peer mentorship that is happening. But of course, we're sharing opportunities around our business. I'll give an example. If let's say I run an SMEs business and I need a service provider in my business, the first position or the first point of contact will be SMEs Connect South Africa, where I say, guys, I need a service provider. Can you come and help me? I know Tepo, you're doing this. I know John, you're doing. I know Andrea, you are doing 1, 2, 3. Can you please come and assist me with this? That's where what we're doing. We're encouraging to develop market opportunities for SMEs Connect among each other. We only have ourselves. So that is sort of a mastermind ecosystem that we have. Of course, there are requirements that you need to meet to join them. You must be running that business full time in order to join that. Also, you must have been operating for more than a full year, and then you must have been making more than 500,000 revenue per year. So if you meet all those criteria, then you can join. Then it's free of charge. You can join. They meet every first Wednesday. We're meeting this Wednesday. We're actually hosting a gentleman by the name of JT. He's going to be joining us. So if you're interested, you're an entrepreneur, you're more than welcome to WhatsApp me, and then you just provide us with the proof that you're actually meeting these criteria, and then you can join us. First-time property investors, some of you guys even belong to the WhatsApp group. This is where these sessions falls under, that we're going to be meeting on a first Monday of each month. They fall under first-time property investor ecosystem. That's exactly that. We've got a WhatsApp group. For those who are not in the WhatsApp group, you can reach out to me, then we'll add you to the WhatsApp group. And then, of course, then also that we'll be having workshops, physical workshop, estate planning workshops in the coming period. So, I mean, sometime during the year, we'll be having those sessions, workshops for those who want to come to our workshop physical. That's pretty much our ecosystem. If you're interested to be part of the ecosystem, welcome. And that's exactly that. Now, let's get going. Let's see. What happened now? There we go. Now, this is where most of you guys are familiar with. That is pretty much what you are familiar with. And this is where mostly it's going to confuse you. Every time when you're trying to make money, you're going to have to ask yourself, where are you going to make money? Are you going to make money using which structure? Growing up, some of us, we found people famously known as sole proprietors, sole traders. And some of them even had what we call general dealers in our townships and wherever we actually situated in it. It was a famous concept. Over the years, of course, then it kind of lost an interest, or rather it lost that sort of familiar. But most people are actually in the informal trade space. Most people are still trading in their names. Of course, then you've got property investors also who are still doing that currently. But then you get a lot of them who are employed 9 to 5. They tend to be frustrated, and then they're asking themselves, but why should I be actually trading in my name, Shiliboy? Maybe I should consider moving my properties into the company, or should I move them into the trust? Then it becomes a dilemma where people ask themselves those unanswered questions, and then they keep coming to Motiba Private Wealth and asking those type of questions. Of course, then others immediately, they've listened, they've attended our sessions under first-time property investor ecosystem, and then they already know of structures like companies and trust, and then they starting to structure their affairs like that. Now they start worrying about taxes. How do I move money around? How do I make my kids trust fund babies? They worry about all these things, technicalities. And I always say, listen, getting in, you'll learn as you go, because the truth of the matter is that it took me 7 years to actually be where I am. So if you are going to expect me to answer everything within an hour, sometimes it's impossible. Just trust me. Let's get going. Okay. Now, then others who are more advanced now, who are starting to raise money out there using pension funds, provident funds, all those guys with big money, they start to consider what you call limited partnerships. And I'm not going to dwell into that because it's more advanced. These are guys that are raising money, because there's a reason why pension funds actually prefers to invest in structures that has to do with limited partnership because of what we call the flow through of money, meaning that the pension funds are the ones going to be taxed, but we all know that pension funds are exempted from tax, paying tax. Therefore, that's how this money gets into that's why this pension fund prefers to invest through the structures like limited partnerships. That is one of the main reasons. You'll find that someone who will raise money through pension funds will structure their structures including limited partnerships, and then they'll have their own company coming somewhere because they find that they've got different shareholders, their trust and things like that, ultra wealthy people. So you'll find them having companies, but then the money that will flow from pension funds, then the pension funds will demand that, listen, let's have a limited partnerships so that there's a flow through. These type of things, you find them there, but you also find them within the professions, the likes of auditors, lawyers, and all those type of professionals that are sort of required to have a personal liability in terms of their profession. Okay, then like I said, we're going to zoom into these ones that you're more familiar with. And of course, those then who are coming together, they might want to start having things like stokvels where they come. I mean, stokvels, some of us were raised by stokvels, but over the years, they've sort of took a shape where people are starting to put them together and starting to raise money through this method. So this is where you're probably going to find yourself. We're not going to talk of REITs. These are some of those structures that you will find them out there in listed entities. They've got special tax provisions on their own. When they were formalized, of course, they lobbied and then they came up with different tax provisions. We're not going to dwell into that. And foundations and funds and SPVs, we're not going to dwell into that. However, we're going to look at things that you'll potentially come across in most cases. Maybe let's start with a trust. There's a And this is where I want to come. Of course, we all know trust, right? Most of you who are here, you've heard many, many times. You've watched some of our YouTube videos. You've watched my TikTok videos. Of course, and other industry experts, you've watched them and you've listened to them. However, I just want to emphasize this. Guys, there's a founder of a trust. It's not similar to a founder of a company. Why am I saying that? Typically, when it comes to a company, when someone finds or it becomes a founder of a company, in most cases, 99.9% of the time, that person becomes a shareholder of that particular company. But in the trust, there's no ownership involved. You could be a founder and that's it, and you move on. You've got nothing. Like recently, one of the associations that I work with, I became a founder of their trust, but I'm not even a beneficiary of that particular trust. I just funded the trust, I moved on. Okay? So it can happen like that in most cases. So just be mindful of things like that, right? Now, however, in you and I cases, when we're forming these founders family trust, you will typically find us becoming beneficiaries of those trusts. Of course, we need to survive, we need to be taken care of. So then you'll find us actually becoming beneficiaries of these trusts. That's what you will typically find in most of us, okay? Now, why I'm showing this, I want to show you something that is very, very important. We found a trust for particular purposes. And a trust needs to have what you call beneficiary. Otherwise, a trust is not going to exist. Right? It's a requirement. A trust needs to have beneficiaries. And a beneficiary can be whoever a founder wishes that particular person, company, trust, anything can be a beneficiary as long as it has a form, right? Then in your case, you're going to have your family. Let's assume this is your family. Then as long as they are beneficiaries of this trust, it means they ultimately are the ones who have economic benefits, enjoyment of that particular trust, not the trustees. But you can have a scenario where one of the trustees is actually in this side beneficiary. But here is a thing. Here's a principle that is very, very, very sensitive and very, very important. And it can get you into trouble if you don't respect it. And this is where I see most people not. There's this thing, people, when they register trust, to say, it's my trust, it's my... No. It's going to confuse you once you start not understanding the separation of these two things. Where I'm going, once a trust is formed, right? Once a trust is formed, the control and the ownership lies or is bestowed into the hands of the trustees. Let me repeat it. Once a trust is formed, the assets of the trust are vested, not vested, bestowed. They are under the control and the ownership of the trustees. However, it doesn't mean that they're entitled to the economic benefits of those assets. You control and you own the assets, but does not mean there's a very funny legal grounds there. You control and you own the assets, but you don't have economic benefits because you might not be beneficiaries. But if you are beneficiaries, you might have contingent economic benefits. What do I mean contingent? Is that you'll only have vested benefits in trust assets when the trustees have exercised their right, their discretion to say, we are giving Tshepo as a beneficiary 10 rand. Then that means you've got a vested benefits in that you're entitled, you're legally entitled to it. As long as the trustee haven't exercised that decision, you're not entitled, you just have a contingent. So it could happen. Okay? That is very, very, very crucial. That is very, very important to distinguish that. Because if you don't distinguish that, then you're going to have a problem. And you need to respect this. Why I'm saying you need to respect this? Because a beneficiary cannot just willy-nilly do as they please. No, you can't. The ownership and the control is derived by the trustees. The trustees need to act jointly. You can't, because you're the founder of the trust, and do as you please here. That's where it's very important. You can't just be willingly taking that trust card and swiping. Next thing, when we check the bank statement during the trustees meeting, when you have been popping the bottles, it doesn't work like that. Every decision must be exercised by the trustees jointly and act jointly. They don't have to agree. But the fact of the matter is that they should have applied their mind independently, but then the decision must be taken. But they don't have to agree. Then if they don't, in making decisions, then we're going to refer to the trustee to say, what does the trustee say with regard to the decision making of this particular trust? That get it wrong, okay? That is the principle that I want you guys to understand. Most people get it wrong. Okay, now let's go on. Now, with the trust, there are benefits. Okay, one of the biggest benefits that it's old common law principle. You probably know it, conjugal private principle. It just means that the income that comes from outside of the assets that are owned by the trust can flow through the trust and goes to the beneficiaries, and the beneficiaries are the ones being taxed. That is the principle that you just need to know. Why is that principle so important? It's very important because I'll give an example, and this is why I combine tax and financial planning. Now, you know when you take life cover, let me give an example. When you take a life cover when you are young, because remember, you can only take life cover when you're from 18 years old. When you take a life cover at the age of 18, it's not the same as taking life cover at the age of 40 or 45. It's not the same. There are people who take life cover at the age of 18 and they benefit from things like loyalty programs that are there. They benefit. I mean, there's another thing called wealth bonus. One of the product suppliers, I'm not going to advertise them here. They didn't pay for me for that. They've got what you call wealth bonus, where if you have been with them for 15 years, they're able to give you that money back, some of the money back. So, which means that if I take my life cover the age of 18, by the time I reach what, 18 plus 15, about 33. By the time I reach 33 years old, I get that particular money. That can kickstart me for my first property. It's a simple way of making money. Because remember, guys, you and I must look for these little ways of making money, right? We must look for these little ways of making money. Easy. You get that. But also the premium of that particular person is way cheaper than compared to someone who's going to take their life cover when chronic illness are kicking in. Because we all know as we get old, and yes, it's nice, you're mature, you're smarter, you're experienced. But the thing is, there's a disadvantage of it. Some illness that tend to chop in, kick in, and things like that. So all these product suppliers knows and then becomes more expensive. This is tax coming with financial planning, guys. Now, from tax point of view, we can move this money and move it and give it to these little ones when they reach 18. So which means that they can even pay for their own life policies and having minimized their taxes because they're 18 years old. They don't have much of tax rate. They don't have much of income. So it means also their tax bracket is lower. Do you see? So they're benefiting from tax. They're benefiting from the financial system. That's how you plan your things. They can also start taking advantage of tax-free investments, things like that, where they can even cash out those things when they go to university. Why not? They can even pay for their medical aids. They can even start taking retirement annuity, guys, as young as they are. They would have saved up on their, what do you call this thing? They could have saved up on their tax and then just put that money back into their retirement and investment. You're basically distributing your wealth when you're still alive. And this is one of the smartest way to distribute wealth when you're still alive, so that when you passes on, these people don't even fight. They've got their own money. You set them up and they can do as they please as they go on with their lives. That is how you can actually utilize this conduit by principle to kickstart your keys, by the way. Just kickstart them and move along. Okay, now let's quickly move on. I'm mindful of time. Now, remember we spoke of trust and I spoke of high level of the benefits that comes with it. Yeah, guys, you're more than welcome to put some of your questions here, there, and there. And yeah, if you're happy, you can compliment. Let's keep going. One of the things that I think by now that I feel that some of people still are not familiar with is that any form of brand new entity, whether it's a trust or a company or a partnership, you can go there and buy a property when it's still fairly newly formed. It can do that. So I think this is something that I know some of you guys are very knowledgeable. You've watched our videos, you're already familiar, but let me just revisit it. So you start a company, you're a founder. Now you technically probably owner, unless this company is owned by the trust. You're one of those people that says, listen, Shilly Boy, my companies and my wealth is going to be owned by a trust. That's good. Probably you're minimizing capital gain tax, you're minimizing estate duties, and you'll see later on what do I mean. Then obviously you obviously then become compliant. You as the shareholder, you need to be compliant and things like that. But you find that you don't even have affordability, so you don't become a director of that company. And then you go to Shilly Boy and say, Shilly Boy, can you stand for surety for me? That's technically. Then what you then do, you're going to make that particular person a director and you don't remain a director of that particular. That's how the banks are still lenient. They're going to just look at Shilly Boy as a director, you as a shareholder, they're not going to. But one of the curveballs with this is that the banks tend to say Shilly Boy needs to own at least 50% of the company. That is sort of something. But then, there's a way of bypassing these things that I don't think I can communicate them now here. But there's a way of where you can end up finding that Shilly Boy owns less percentage than 50%. That can be done. Okay. So just let's see. Let's try to go back. How does this thing work? Oh no, wait. Sorry, guys. You know, when you're old school and you are trying things that you're not even familiar with. I was looking for, okay. This thing is weird. So I was looking for forward and backwards. Okay, let's go on. So I'm sure that you guys are covered here. Now let's look at someone who now operate using their names. One of the disadvantage with building portfolios, and this is again where you're gonna see financial planning comes with tax. Now, there are people, you know, guys, we buy things for different reasons. Some people buy wealth and you just want to feel good that I've invested in my name. They've got properties. They love that thing. Title deed are in their names. That's good. That's their personal decisions, right? Or others just feel like, listen, Shiluboy, I'm not interested much. I'm not going to be a role player, property investor with multiple portfolio. I'm not interested in that, in those hustles and stress. I just want to build 10 properties, maybe 15, I'm okay. That's it. And I just want these properties to take care of me during my retirement. When I reach 55, they must be able to take care of me, or when I reach 65, because in this current climate, I don't see most of us retiring at 55. Probably gonna be working until 65, 70, somewhere there. Right. Now, you could be building that portfolio in your name. That's what you choose for. You want that, you respect you for that. So what then you need to be mindful of is that you're going to pay estate duty. What is estate duty? It's the tax that you pay on dutiable amount, which is what we call assets, value of your assets upon death, minus all liabilities and other deductions. And then any balance that is remaining, basically, SARS is taxing you on your net worth. That's basically that. In fact, let's put it that way. SARS is taxing you on your net worth. Before your wealth can be transferred to the next generation, SARS says, come here, let's come and share with you. Okay? Anything up to 30 million is taxed at 20%. Anything above that is taxed at 25%. It's similar concept, similar to donations, because donation is also some form of a wealth tax. It's a cousin, actually, this. Donation is when you're still alive, you're going to be taxed on that. But then estate duty is applicable upon death. So it's the same concept, same principle, same thought process. So be mindful of that for those who are building these assets in your name. Okay. Now, let's have a scenario where someone here also going to be liable for capital gain tax, because that's exactly what's going to happen. When you pass this on, you are deemed to have sold your assets. Therefore, you're going to be subjected to capital gain tax. That's another thing. So you're going to have to pay lawyers to transfer. You're going to have to pay Mutiba Private Wealth to wind up your estate, executor's fee. You're going to have to be paid that. You may find that some of the properties are still bonded. You're going to have to pay bond cancellation fees. There's evaluations that needs to happen. And effectively, you could find yourself losing up to 30% to 32% of your wealth. It could happen. So when you are doing that, when you're making decisions to do all these things, be mindful of this. And of course, other people says, listen, Shiluboy, I don't care. I don't mind all these things. I'll take life policy. That will cover all these costs. Some people do that. They come to Mutiba Private Wealth. We analyze, we tell them, okay, this is what you're going to be exposed on. Then they decide, okay, I'll take life cover. My life cover will then cover all these expenses that you're talking about. I bring liquidity into my estate. The executor, when they're winding up the estate, then they cover all these costs. Some people do that. Because why? They want the sense of control of, and you find that they don't care. If you tell them that, what happens if you get sued or sequestrated? Like, listen, that will happen. I don't care. So that's their personal decisions. But then you get those who says, listen, I'm not going to trade in my name. I'm not going to have a headache of these things, the process of winding up. I don't want to frustrate my family. Therefore, I'll build all my portfolios within the structure that is owned by the trust, and there are companies underneath that. There are people who are doing that. So it's more of preference, but at least be aware of the cost implications when you are trading in your name. And of course, also be mindful of the cost when you're trading within the trust and companies. So that is typically what you need to be mindful of. Okay. So we already discussed the trust, the natural person, and the company. And these are typically differentiating factors. What we are always saying, limited lifespan, because you and I, God forbid, we're going to pass this on at some point, right? So which means that we don't exist in perpetuity, but then trust in a company can exist. So it minimizes the process of a changing of ownership, because any form of change in ownership, there are cost implications involved in all these things. Of course, then there are these high taxes. Trust, we all know. If you don't use that conjugal power principle and then the money retains in the trust, then the trust is going to be taxed at the higher tax brackets. That is the reality. 45%. Then a company is about 27, if I'm not mistaken. Yeah, I think 27% right now. Right. And then, of course, the natural person, they've got those scaling rate from 18% to 45%. Of course, then the issues of scrutinies and things like that, you might be subjected to various, especially in these days, there's a lot of scrutiny when it comes to compliance. Trust is SARS once beneficial owners organogram, beneficial owners registers. It's just, yeah, there's a lot of admin that is happening right now, irrespective of which entity you're using, unfortunately, these days. There's a lot because of that high thing where we're listed in the what do you call that thing? A gray listing of some sort. So it end up creating so much onerous regulatory environment in the country and globally. So we are not immune from that. So there's a lot of scrutiny that is going on where a lot of information is required. Trustees are required. Minutes of the trust are required of the companies. Is just too much of disclosure that is required, unfortunately. But just be mindful of those things as you are creating wealth. But you can hire experts to deal with such admin and the likes of TaxEdu, the likes of Mutiwa Private Wealth, to worry about things like that. Okay. Personally, I'm not a fan of trading in my personal name because of the admin and the implications of the estate. I don't want my family to be subjected to so much onerous disease estate administration. I just want lifestyle to flow through seamlessly. Can I just be buried in the mass, mourn as they go, but their life should not be interrupted. I don't want that situation. Okay. Now, typically, then you will then find people having this type of structures. Let's see. This is typically exactly what I was saying. This is typically the type of structures that you'll find. Those who are very established, you'll typically find them having this trust here that is not really exposed. It just receives all these dividends and it keep reinvesting with the likes of Mutiwa Private Wealth, where we take your money, put it with the fund managers and things like that, and into investments that then they bring all these income that comes into this particular trust. This is typically what you'll find people then, because why? This trust here is going to be exposed a lot. It's going to be exposed from surety point of view these days. They want all these things. So people always try to move their money. But I'll always advise this structure for someone that is really, really serious and operational, to be honest. The basic structure that I'll say, if you really want to have this type of structure, it's just to have maybe one trust and one company. Maybe because you want to buy more properties and because of your partnering with other people, you might end up having multiple companies underneath that. This is a scenario where someone is into property and other form of businesses. They even fall within SMEs Connect South Africa ecosystem. Then I'll say, because of the risk nature, rather separate these entities so that you don't find yourself the risk of this business affecting your property portfolio. You don't want, I had clients where they, maybe medical doctors, they practice and they buy property. Some people like that. And they're willing to take those type of risks for whatever reasons. I was challenged by one of my clients and I agreed because they showed me something on why they did that, which was quite smart. And then they've got farms and things like that within the same entities. They keep flipping things around. But, it's a high risk type of a client. But for someone who's more risk adverse like me, maybe it's not a good idea. Separate your entities and move along. So that is typically the structure that ultimately you'll find yourself in. And yeah, let me thank you. And I think it's very hot here. Joburg, I'm not sure why it's getting so hot lately. Let me thank you so much for coming through. And I'm gonna open, I think we've got 15 minutes to take questions. And you're more than welcome to ask questions. You can raise your hand and I'll recognize you and then I'll allow you to talk. And outside of that, yeah, let's see who's here. Who wants to jump in? Just raise your hand and then I'll allow you to talk. Are you guys covered? You don't want to ask questions? Okay, there we go. I think let's start with Sanele. I think you're the first one. Go ahead.
Evening, sir. I hope you're good. I hope you're, and thank you very much for such an insightful presentation. I want to ask you with regards to formation of trust and holding companies, because as an entrepreneur, you find that mostly when you get into business venture, you stand at this side, it's quite hectic. Okay, when you get
Where
into
are you?
I'm in the Western Cape, also, and
Oh, I hear that is crazy there. Okay, continue.
yeah. Okay, so how will you advise that? How would you advise where to start for an early stage startup entrepreneur who's currently busy with a number of businesses and also want to mitigate risk, bearing in mind that some of the investors, also like government entities like SEDA and CIFA, once a company is diluted by a trust or another holding company, they are quite they're not comfortable with funding that company. They always prefer natural persons. So I just want advice on how to navigate that space.
Yeah,
Thank
you so much, Sana. That's quite a very relevant practical example. I like that. The truth of the matter is that tax and financial planning will somehow have a conflict, or what do you call it, headbutts with other stakeholders. And you see these a lot in business. That's a typical example. So as an entrepreneur, then you need to make a decision to say, what are my priorities? Are my priorities right now to grow the business? Or my priorities is to preserve? And what about things like, what do you call this thing? Trust and things like that, right? So that's where you need to, and no one can really tell you which one is right and which one is wrong. You're going to have to make that conscious decision to say, if I'm presented with this opportunity of being funded with the extra grant of R1 million or 500,000, am I not better off to have me owning the company directly and then build up my business where I don't need? And this is where most entrepreneurs actually do that. They take a risk, they own the company directly. When they feel that they don't even need, they build up their balance sheet, they build up their credit profile with the banks, and now it's easy for them to raise money without too much questions. They've got private bankers. Now even bankers goes to their offices. You're no longer queuing at the branch. That's when people then start to say, okay, maybe it's about time I preserve my wealth, and then start considering things like trust. You can do that, right? But you must be mindful that during that time you are exposed. But then other people then to do what? There are businesses that you may find that you are an entrepreneur in various ventures. You need funding from government agencies and things like that. But then you find that these entrepreneurs suck money some in this entity, reinvest into other things, like you are into property also. Property doesn't need government grants and things like that. It's very rare, right, that you'll need, unless you are into social housing and things like that. Let's assume you're not into that. You could easily then move this money into the structure that has to do with trust, that has nothing to do with government benefits and things like that. So you're pretty much sucking money into more secure place. You can also do that over the years. And then as you build this thing and growing on its own from reputations and market and things like that, when now you don't need even government grants, or you're no longer even qualifying because at some point they are not going to qualify, then you can then always sell the shares into the structure, knowing that you are moving this wealth now to the next generation, number one. Number two, you also do what you call packing. Packing meaning that you are fixing the growth of the estate into the trust. Then you move on. So that is, I personally will advise the client to consider that. You just need to weigh the cons, pros and cons, to say, if I retain and I don't take grant from government, would I grow with that grant? I doubt it in this difficult climate. I doubt it. If we can do the grant of 2 million, why not? I'll rather sacrifice the trust and having a trust than not having a grant. I hope I answered your question. Let's allow Asake. Please go ahead.
Thank you so much, Shiluboy. Such an eye-opening conversation, especially with the man upstairs, which is SARS and tax. My question really is for a first-time investor in property and how they could best structure their tax returns, especially when the holding of that property is in their personal name.
Yeah. Okay. I'm just going to quickly show you something. Okay, guys. Okay, maybe let's put it this way. Before I go there, actually. When you are earning rental incomes in your name, there are very few things you can do, unfortunately. You're going to be taxed on your marginal tax rate. What do I mean? If you are already at the, because of your salary, you're already sitting at the tax bracket, say 36%, 40%. It means any taxable income that comes in as a result of your rental is going to be taxed at that 36%, whichever brackets you fall under. Are we in agreement? Now, what can I do to minimize the tax? Probably it will be record keeping, because most of you guys don't do record keeping. You don't keep your invoices. You don't even, one thing that I'll advise, separate your entities. Separate your entities in such a way that the entity that has to do with, what do you call this thing? The bank account, rather. The bank account that has to do with your personal family things, your salaries and things like that. Separate it from the bank account that has to do with your properties. And then you'll be able to have a clear view of which expenses has to do with your personal and which one has to do with properties. Then you're able to minimize your tax from there, because once you calculate all those expenses, any expense that runs within that, then you can deduct it and reduce your tax. I think that is number one, keeping all those records. And then the other thing is to come to Motiba Private Wealth and say, listen, Zwi, who is one of our private clients advisors here, please find me a retirement annuity so that I can, minimize my taxes. And I'll show you why. Let me quickly go into the calculation. Just want to, let me run, where's that thing? I'm looking for, I want to show you the calculations. Where did I put it? Shiluboy. Where did I put that thing? Okay, there we go. Okay, why did I struggle so much? Asake. Can you guys see my screen? Okay, that's fine. Okay, now take this. I want to show you something, another way. I remember I spoke about preparing, like making sure that you are your expenses all like your record are clean. That can help you to minimize your tax. Number two is things like retirement annuity. Top up. You come to Motiba Private Wealth, you speak to people like Zwe and say, listen, get me retirement annuity with your product suppliers. And then we assess you, say how much you're going to contribute. You say, listen, I've got extra 5,000 of rental income that kicks in. I want to minimize that. Can you help me? Then we do that. Let me give you an example. If you can see my screen here, I put Shiliboy Motiba there, tax number 0000. I was born on the 1st of the 1st in 2000, 2000. Right? These are my personal details. Now, let's assume I'm earning an income of, say, 400,000. Or let's do 5. Let me give myself at least 500,000. Did I just give myself 5 million? Right. Now, if my gross, forget anything else, if my gross from my employer, it's 500,000, it means that I'm going to have to pay SARS a tax of how much? 100,000. Do you agree with me? Right. If I earn, I don't have anything else, I'm clean, I earn 500,000, I'm going to have to pay SARS 100,000. If you do the calculation, you'll actually get it. It's like this. That's a tax that you'll probably pay if your gross is 500,000. Now, then let's look at someone who says, no, Shiliboy, I know that 500,000 also has a bit of rental income that is inside there. So Shiliboy and you and your private clients, advisors at Motiba Private Wealth, can you please give me RA King, Retirement Annuity Fund. Let's go. Then we deduct it here. We say he takes this RA here. And then let's say every month he contributes, for argument's sake, 5,000. He doesn't need this 5,000. We're assuming he doesn't need this 5,000. He's willing to invest. He's worried about his retirement. He said, I'm young, but when I'm still making money, let me put something aside for when I'm older. Right. He's worried. That's another way to reduce tax. But it's also always advisable. It needs to be something that you'll be consistent in paying this thing. And it needs to be something that you can afford to pay on a regular basis. Maybe let's say he doesn't want to put the whole 5,000 because he wants to pop the bottles on the remaining. Maybe he put 2.5 aside. Then for 12 months. So it means he put what, 30,000. That's what he wants to put, right? Because the rest he wants to go out and have fun. That's fine. That's part of living, right? Now let's look at, remember that the tax was about how much? 100,000. Now let's look at what happens to the tax now. The tax now is what? 90,000. Do you see the difference? Unmute yourself, Asake. I'm talking to you. Asake?
Yes, Shiliboy. I can see the difference. Yeah, so there's that one way of maximizing on tax as well as the tax-free savings. But now I'm looking at other avenues whereby I can leverage more on the rental income.
Not tax-free investment. Tax-free investment it's not deductible, Chief.
Yes, yeah. It's only the...
This is a retirement annuity. Yeah, continue.
Yes, so besides the retirement annuity, what are the other avenues one can look into in terms of saving up on tax?
The other thing is not really going to benefit you. Well, it depends on who you are. If you are one of those people, unmute yourself. I want to have a conversation with you. One of the things that people then tend to do is to build what you call social capital. Depends on who you are. What type of a player are you? What do I mean? You could be wanting to be a person of standing in your community, right? You want to be a person of standing. You want to immortalize yourself. Remember, self-actualization differs from each people. People want their names to live on beyond their death.
Sure.
And it doesn't mean you have to have millions for you to actually realize immortality. And I know it sounds very psychological, whatever, philosophy, but it's a reality. We want to be worshipped. Some people want to be worshipped. And that's why they've got names and everything after them. That's a worshipping. Now, why I'm saying this? I'm saying this because it comes back to text also. You can do that. Why? Let me show you again. Now, if you then go back and say, listen, I'm going to pick one township that I grew up in, and I'm going to ask the school to name a classroom after my name, Shiliboy Mutiba class, grade whatever, grade 7. Then every kid must remember my name by the time they pass grade 7. Then I'm willing to donate money on a monthly basis. I mean, obviously, it needs to be reasonable that it's worth naming a class after you're a ground or something. And let's assume that you can buy your name using 5,000 per month, for argument's sake. Now, that's social capital, by the way. That's why other influential people, we're not going to name them, they keep donating to the public. When you see them, what you do? Don't you respect and worship, to a certain extent, worship them, praise them, maybe praise them? That's social capital power. It actually even opens certain doors because you are a man of social standing. It's easier to be invited. Now I'm talking at the extreme level. It's easier to be invited in specific events because you're a man of social standing or a woman of social standing because of donations that we make. Donations can be another form of marketing, by the way. It's a business market. It can be a business expense that you consider. Now, let's look at one of the deductions. Here's a donation here. Now, let's say you donate 60,000. Remember, you were paying 90,000 again. If you remember the deduction. Let's say now you say, Shiliboy, I've got a church. I want Sunday, whatever choir to be named Shiliboy's choir, whatever. Asake choir. It's actually written even nicely. Asake choir. Then let's see the tax implications. Remember, you are supposed to pay. No man, what did I do? It can't be. Didn't populate. Let's start again. Let's see. It didn't populate. Okay, let's try. Let's go back. Clear we're gonna have to start afresh. Systems always not populate. 0, 0, 0. 1, 2, 2000. The principle here I was going to say is a tax, remember, is tax deductible. You can what do you call? You can why is this thing still showing not cleared? What is this? I was like, I don't know. Maybe it doesn't want you to have a social standing. I don't know. I don't know why the system is refusing. It's not me, it's the system. It's like, you see now you're corrupting a cycle. So that is another way. I think the moral of the story is that you see us like this thing doesn't want to.
You must put my name, Shiliboy.
I must put your name, ne? Ish. Busy. Maybe it's my ancestors. Why not you want to be immortalized now? What is this thing of wanting to be immortalized? Let's see if it will pop up. Because you see the deduction is not coming through here.
Yeah.
And I'm not sure why it's not popping up. Let's see. Yeah. I'm not sure why it's not coming. But can you see what he's saying there? The note there. Can you
Yeah.
read the note?
Donations deducted. Yeah.
So it says donations deducted from the employee's remuneration and paid by the employer to an approved organization or institution, including to COVID disaster and other. That's, you remember that solidarity fund. Let's actually do this so that you can read the entire thing. A maximum donation to be allowed as a deduction by the employer when calculating the monthly pay is 5% of the employee's remuneration after deducting allowable retirement fund. And so that's when we are calculating, but entirely someone is allowed about 10% of their taxable income to be deducted. So you are limited up to 10%. So which means what the principle here that I want to say is that if you are doing donations, yes, you can deduct it. I think that's the principle that you just need to have.
Sure.
That is one way of that is sort of one way of things that you can, maybe let's look at other things that can benefit you. It's RA, I mean, medical aid, I mean, it doesn't really have much. It could be also the issue of travel allowance. I mean, those ones, they has to do with your car. So it has nothing really to do with, with your additional income. Your additional income that could be within your control will be RAs and your donation. You can actually even see here. It has to do with medical. Medical is not a lot, man. The rate, the medical tax credit is not as impactful as pension fund, RAs, and donations. And the donations, I think for me, it's when you've got money right now, like when you're making money, not when you are still hustling. and then, but I mean, it depends on personalities. It depends on what you're trying to achieve. But I wouldn't do it personally. I'll probably do it, when I'm starting to worry about self-actualization.
Sure.
Yeah.
And then one last thing, Shiri boy, you mentioned a lump sum contribution towards one's retirement annuity. I'm not sure how that works. So at the moment, I work in a school as an employee, but now I'm also a creative. So I sing, I'm a performer, I'm a musician. So music performances, there's always lump sums of payments upon performance. So I'm trying to see how I could maximize on those.
We can do, if you want, we can help you with what you call alterations, and we can take those lump sum and contribute towards your RAs. We can actually do that. We can do that instead of popping the bottles.
All right, sure. No, thank you so much, Shili boy.
Those who want to be in touch with me, I mean, I think, man, you guys have got my number. I'm sure by virtue of being here, you probably have my details. You can wait in room, but it's not. What am I? No. What's going on here? I want to. Oh, okay. I wanted to send my number. For some weird reason, I struggled. Come, or Moari. Let me rather Ole Boreng.
Yes. Hi, Shiri boy.
Yes.
Thanks a lot for the session. It's been very, very informative. From my side, I just have a question with regards to the whole separating the personal affairs and in terms of property rentals. So, like, would it be advisable, or rather, from a tax perspective, would it make
Sorry,
sense?
just come again.
Sorry, can you hear me? Hello?
Uh,
Hello?
Yeah, just repeat what you just said. Hello? What's
Hello,
happening?
can you hear me?
Yes, I can now.
Okay, so my question is from the standpoint of, like, if it's advisable to separate like the property rentals from your personal name by using a business account. So say, for example, you have a business that you've opened, and then you then transfer all the rentals that you are receiving from your property to the business account, and literally then doing all the transactions from that business account that relate to that property, even though the property is not in the name of the business. So the property is in my personal name, but then the transactions are made from the business account. Is that something that is advisable to do? Does it make sense, or would I have to transfer the property to the business?
There's no right or wrong. Can you see my screen?
Yes, I can see it.
Now, this is typical what people do. Moagi will take rental income into the business in the name of, I don't want to be taxed. This relationship is incomplete, because I can argue and say you're actually donating money to the business. Because why should the business be the one receiving the income if it doesn't own the property?
Okay.
That's my argument. So if I was SARS, I'll say, charge this person donation tax. On top of that, charge them for income tax for the rental. Do you see how it's going to be a blow?
Yes.
Then others say, okay, then let me get the company to rent from Moagi.
Okay.
Then getting Moagi to rent, the business to Moagi from rent, it means that this business must pay Moagi something. Would you agree with me?
Yes.
For the rental that it's receiving.
Yes.
So which means that Moagi will have a rental income from the business will have a rental income from the tenants.
Okay.
Depends on what the agreement is, then you're going to have to show in your taxes that you've got a rental income. So it's a duplication of work in a way.
Okay.
That's what people do. Why would someone do that? People can do that and then just charge a fair amount, not actually what you are. What is a fair amount? Maybe I'm not going to give you a figure, but charge a specific, like a model that people, the rent-to-rent Airbnb model that people like doing.
Yes.
So you can see that as that. And then a chunk of more money will be here. It's a bit of admin. It needs to be, the reason must be because maybe you are one of those high tax brackets people who are sitting at 45 and 40%. Then it worth the hassle.
Okay.
Yeah, that is typical.
So the agreement, the rental agreement between the business and myself would have to be like a drawn up agreement.
Yeah, it has to be, because if you get subjected for an audit, then what are you gonna do?
Yeah. Okay. So in essence, it's not really worth the effort. In other words.
I'm not saying I'm not the one to make a judgment. I just showed you. I just showed you remember these things. I just have to highlight. But remember, our preferences are different.
Yes.
But this is, from tax point of view, this is what you need to be careful of.
Okay. But then from a point of view of, let's say, building the business profile. So if you want to build the business as its own entity,
it doesn't matter. Let me cut you off. It doesn't matter, because the truth of the matter is that Banks will never see you as independent, your business as independent of you anytime soon. That one I can show you. You'll always be considered self-employed for a very long time. That is not the truth.
All right.
They will always want to assess this way holistically. They will always want to do this. You are still, hey, you have to be a very big company for them to start ignoring you.
All right. No, it makes sense.
Yeah. The more you build assets, it's just helping you holistically. They will not see it as singular, this thing. They'll always want to bring you in here.
Okay.
It's in their best interest.
All right. Makes sense. Thanks.
Sure. Okay, guys, I'm mindful of time. Henry, you are the last one. Guys, the session was supposed to end at what do you call? Where's Henry? He disappeared. You are the last one. The session was supposed to end at 7. Come. For those who wants to reach out, you're more than welcome to send me a WhatsApp. We can do consultations. My team is around. We can allocate other people to help you. Whether you want financial planning advisory, you're more than welcome to reach out. Whether you want Henry.
Thank you so much. Mine is a quick question with regard to rollover relief. Say there are two businesses that I have. One is a property business. One is not really in property. The property business is stable, cash flow positive, but then the other business is in infancy, and I am trying to use the property income to sort of reduce my overall tax liability. Is there some sort of tax planning from a small business perspective that I could use?
What, those businesses are separate? Henry? What's happening? Henry?
Yes, the businesses are separate.
Nah, there's nothing you can do. It needs to be logical. Remember, if things, then there's something in text, what you call schemes of arrangement. Why Henry disappearing on me? Pella, for us to...
I'm here.
For our conversation, we need to clarify things and finalize quickly. There's something we call schemes of arrangement in tax. If SARS find that whatever you are trying to do, the purpose of that scheme was to bypass tax, they can overlook what you've done and tax you on the true sense of the transaction. So, which means that whatever you're going to do, it has to make sense. And this is where typically holding company structures matters. What you're asking me. Let me show you something. You guys are worried about tax. You should be making money and just donate SARS. Let's say you've got the company A1. Then you've got company 2. Okay? Whatever, this one make loss, whatever, it doesn't matter. Then you've got a holding company here. There are services that are being rendered here on behalf of these entities. It needs to be commercially sense. You may find that you are doing HR here, you are doing capital raising here, you're doing marketing here. There's certain shared, we call them shared services. There are certain shared services that you are running them here. Then you can invoice this company, it can pay this holding company a management fee, then it pays this one. So that one with income, would you agree with me that that income will be reduced by that invoice?
Yes.
That is logical commercial sense that you can buy, you can do, but you need to prove to me that there's someone that is sitting here doing work on behalf of this. You went quite on me, Henry. Okay, I'll assume that he's covered. Okay, guys, thank you so much. I appreciate. Please, for those who haven't subscribed to my YouTube channel, there's there. And then my team will be reaching out to you guys. Yeah, I don't know if I've got your details, but in the coming 2 weeks, we'll be reaching out to you to check on you, to find out if everything is okay, you need any form of help from us. Don't be surprised when someone is calling from my office. Yeah, then otherwise, if it's urgently, you can send me a WhatsApp. My number is on my profile. I mean, my number is on my WhatsApp on the chat box, or for that matter, you could just, if you already have my number, you can just WhatsApp me, and then we can then take it from there, allocate a team member who can assist you. Otherwise, I'll see you again next month, the first Monday. Reach out to so many people, tell them about us, share with them my profile on, and then, yeah, refer clients to us. That'd be great. Well, we'll appreciate that. Otherwise, good evening, good night. Can I ask Zui and Kuku if they're still here to remain, and the rest of you guys, good evening and good night. I don't think Kuku is here. Yes, there'll be a referral commission. That's fine. I don't mind. Let's all survive. As I can, yes, yeah, there'll be a referral. We must all survive. What's the point of me eating alone? We must all survive. Okay.